Good morning and welcome everyone. Thank you so much for joining us today. We are so excited to have you here. Will be an opportunity for us to learn from each other and grow. For those who don't know me, my name is Rahma Al-Alwi and I will be your moderator for today. Let's take a moment to introduce our company. So Alliance Prime Accounting and Tax Consultancy is an FTA-approved tax agency with more than 20 years of experience. Next slide, please. We are a leading accounting and tax firm with highly educated and skilled finance professionals, serving clients across diverse industries in different countries. And now let's proceed with introducing today's speakers. Mr. Abdurrahman Ali is our Corporate Tax and Transfer Pricing Director. Mr. Mahmoud Misbah is our Corporate Tax and Stat Manager. And finally, Mr. Sayed Shahrayar, our Tax and Audit Manager. Today's webinar will be on the importance of the corporate tax and transfer pricing in UAE, and the agenda will be, next slide please, as showing on the screen. Sorry for this. Next slide, exactly, thank you. You will have the opportunity to submit questions by typing yours into the Q&A window. You may send them at any time during the presentation, and we will collect these and address them during the Q&A session at the end of today's webinar. Now, without further ado, we will turn the time over to my colleague, Abdurrahman. Abdurrahman, the mic is yours.
Thanks, Rahma. Welcome everyone to our today's webinar. Thank you for joining us. For who do not know me, my name is Abdurrahman Ali. I'm the Corporate Tax Director based in Dubai office. Let's start a quick intro about what is corporate tax regime. A tax system can span between either direct and indirect taxes. First, indirect taxes, which are imposed on value-added activities and are usually borne by the end consumer, such as VAT. We have witnessed since January 2018 the implementation of VAT in the GCC and especially in the UAE. Second, corporate tax. Corporate tax is classified as direct tax system that is impacting business profits directly, which its cost shall be deducted from net profits. In order to be subject under the scope of direct tax system, the UAE corporate tax law, either natural or juridical persons have to be resident for tax purposes. This means that tax residency is key factor of determination for being subject to corporate tax in the UAE. The residency conditions and criteria have been clarified in both Cabinet Decision 85 of 2022 and Minister Decision of 27 of 2023, effective from March 1st, 2023. The corporate tax is meant to be charged for any person, either natural or juridical person, who commence a business or a business activity. Throughout our today's webinar, our focus is on the juridical person only. In simple words, we will focus on companies. Under UAE corporate tax law, it does not require the persons to be only incorporated in the UAE to be subject to tax, but could be having a place of residency other than incorporation, such as effective control in the UAE or permanent establishment for non-resident persons or other conditions as nexus or state-sourced income plus others. During this webinar, we shall not cover the aspects of non-resident persons, but inshallah, we will cover some aspects in our upcoming webinars. Let's now delve into more breadth of the corporate tax mechanical work. So, Shahriyar, could you shed please the light on the starting point for taxable persons from financial point of view?
Thanks, Abdurrahman, for the overview on the city and residency regime. And thanks, Mr. Rahman, for the introduction. Hello and good morning, everyone. For those who do not know me or just join us now, my name is Sayed Shahriyar and I work in Alliance Prime as a tax and audit manager. Since my colleague Abdurrahman discussed about the residency importance, direct and indirect tax, I'll discuss about the financial statement and its importance for the city perspective. As you can see on your screen, and most of us knows about the financial statement, which include balance sheet, income statement, cash flow statement, equity, and notes to the financial statement. Now here comes the question, why are we discussing or why the financial statements are important for the city perspective? As you can see on your screen, as per the Article 20 of city law require every taxable person to maintain stand-alone financial statement. And Article 54 of UAE city law granting discretion power to FTA or Minister of Finance to request financial statement from the taxpayer. Financial statement would be the starting point for taxable income, especially the profit and loss statement, which would be covered in detail later in this webinar. Requiring category of taxable person to prepare and maintain audited or certified financial statement. By the way, this was a quick review about the financial statement and its importance, financial statement and its importance. Now let's have a look on the next slide, which is UAE city regime. Since we know that corporate tax federal decree was issued on October 3rd, 2022, which encompasses the first tax period, as we all already know, shall be the fiscal year starting on or after June 1st, 2023, which will be similar or same financial year as per the financial statement for the 12 months. As you know, most of the companies in the UAE and most of our clients even having financial year from January 1st till December 31st, which mean their first day for the corporate tax start from 1st January 2024, and they must submit the tax return within 9 months after the financial year end, which represent their tax period. From our perspective, from our practical experience in other countries, applying residency principle, which indicate that worldwide business profit shall be subject to tax in the territory where they are incorporated or resident for tax purposes, similar applicable under UAE city law. As per Article 3 of the Corporate Tax Law, taxable resident person shall be subject to tax at either 0% or 9%. In our upcoming slide, we shall cover some aspect of the 0% implication while discussing the free zone businesses. We can observe that the highest or standard corporate tax rate in UAE is 9%, which still represents a global competitive tax rate. Now, since we discussed about the 0% and 9%, now the other hand, there are specific persons that shall by design of the corporate tax law be classified as exempt person. We are still observing that there would be further public clarification, consultation, and guides that will be issued either by Minister of Finance or Federal Tax Authority. Now let's have a look on exempt person, which is you can cover on the next slide. As you can see on your screen, the exempt person list, as we already discussed, the 0 and 9%. Now let's have a quick look on exempt person. Usually, whenever we talk about the exempt person, here comes some questions into our mind, like what are the exempt persons, why are the exempt person, and who are the exempt person? So we look in a little bit detail for this question. Let's say what is exempt person? There are certain type of entities which are not subject to corporate tax as per the corporate tax law, Article 4. Why they are exempt? Because the main business activity or mandated activity, which means they are not conducted business or business activities, and yet they are playing strategic role in the EU economy. So in case of those exempt persons, if they have conducted business, they shall be subject to corporate tax. Now, who are the exempt persons? As you can see on your screen, those are the non-exhaustive entities which are exempt from city law as per Article 4. Now we will cover in a little bit detail now. As you can see, the government entity as per Article 5, the federal government, local government, ministry, government department, government agencies, authorities, public institution of the federal government or local government. And as per Article 6, government control entity, any juridical person directly or indirectly wholly owned and controlled by government entity. Qualifying public benefit entity, any entity that meets the conditions set out in the Article 9 of this city law entity, and the listed is in a decision issued by the cabinet. Extractive businesses and non-extractive businesses. The business or business activity of exploring, extracting, removing, or otherwise producing and exploiting the natural resources of the state or any interest therein as determined by the minister, so-called extractive entities. Now, non-extractive businesses. The business or business activity of separating, treating, refining, processing, storing, transporting, marketing, distributing the natural resources of the state. It's obviously that executive and non-executive entity are not subject to city federal law, but they are subject to Emirates level taxation. Now, qualifying investment fund. Any entity whose principal activity is the issuance of investment interest to raise fund or pool investor fund or establish a joint investment fund with the aim of enabling the holder of such an investment interest to benefit from the profit or gain when it meets the conditions set out in the Article 10 of this decree law. All these entities we will discuss in our future webinar, inshallah. And now it's time to pass the mic to my colleague, Mr. Mahmoud.
Hello, everyone. As we discussed about the financial statements and what the relation between financial statements and the CT, especially the P&L statement, let's take a snapshot about deductions. Businesses usually incur expenses in order to generate profits. Such expenses that related to the core business activity during reporting period, which is recognized under accounting standard IFRS. Some example of such type of expenses can be salaries, rent, depreciation in fixed assets, utilities. Those type of expenses are fully deductible for CT purpose by design of the law. However, there are certain types of expenditure that may be not qualified for full or partial deduction under city regime, such as entertainment, donation or charity, contribution, and interest expenses. Let's take an example. As per Article 32 of city law, entertainment expenses is partially accepted to a rate of 50%, which means that the remaining 50% will not be deductible for the calculation of the adjusted taxable income. From our practice, we saw that there is a certain limited criteria which may trigger full deduction for entertainment expenses. For interest limitation impose a level playing field for business where they need to be careful about their debit levels due to the fact that as per UAE city law, only 30% of EBITDA shall be the cap of interest expenses to be deductible for corporate tax purpose. However, in recent publications, we could observe the ability for threshold that allow a full deduction corridor. For donations are those expenses of charitable character business may incur. Such expenses may be not qualified for full deduction. From our understanding of the law, in order to qualify as a deductible expense for city purpose, the amount of such contribution have to be made to certain entities that are only listed on the qualified public benefit entity as per Article 9 of the UACT law. They are per each emirate. In the next slide, let's have a look over how to calculate the taxable income. First, let's have a quick definition about the taxable income. The taxable income for a period shall be the accounting income of the period adjusted for corporate tax purpose. We have just discussed some aspects of the deductibility of certain types of expenses. Similarly, would be applicable for some income classification that may qualify for corporate tax purpose to be exempted, which is known as exempt income under Chapter 7, Article 22. One example can be dividends received from juridical resident person. The adjusted taxable income is determined by subtracting exempted income and or adding allowable expenditure. An illustration for taxable income calculation can be as follows. Now we have one example on the screen. As you can see, we started from earning before tax EBT for ABC company. And in order to arrive to the taxable income, we made some adjustments. As you can see on the screen, Adjustment 1 and Adjustment 2 represent the type of expenses that have been disqualified to be accepted for corporate tax purpose, which leads to an increment to the adjusted taxable income. The amount of tax expenses is calculated in our example based on 9% CT charged to the ATI while considering the 375K bracket relief at 0% CT. Now, let's think about situation where businesses may incur negative income, which known for tax purpose as tax losses. Let's go to the next slide. From our practice, we could observe a number of clients which may incur losses during their early years of starting their business and corporation or expansion under city regulation insurance of losses shall trigger no corporate tax dues to be paid for current year losses, which give us a perspective about the ability to carry forward such losses to future years, whereas such losses may be utilized against profits that shall arise in the future or subsequent periods. The ability to roll forward such losses in indefinite lifetime, having said that the amount of tax losses used to reduce the taxable income for any subsequent tax period cannot exceed 75% of that period taxable income. So let's have a look in this example shown in the screen for the tax losses. As we can see on the screen, this time ABC company incurred a negative EBT, which subsequently adjusted taxable income is still in a negative position. There is no tax charge since the company is in a loss position from a tax point of view. As you can see, earnings before tax, EBT, it's negative 1 million, and we have two adjustments you can see for entertainment and interest. That means we added back. It's not accepted to be deducted. So the adjusted taxable income is minus 650K, mean there is no tax expenses for this year. We also observe it from the city law. There is a feature with the regulation to allow tax losses of being transferred to other taxable person that's resident in the UAE only if it meets the condition outlined under Article 38, transfer of tax loss. Now, let's have a comment about interest expenses from our international tax perspective. Abdulrahman, can you please comment in this subject before moving on to our next section about free zone business? Abdulrahman, please.
Well, thanks, Mahmoud. Well, indeed, loans are one type of the financing options for businesses to grow, where business shall have to pay the interest on such borrowed funds. The tax concern about interest expense may be viewed as, in a way, if it's being abused by some multinational companies, perhaps, which cause a frustration for the economy and for tax administrations. The corporate tax law enforces a general anti-abuse rule, which is guard provision to revoke the impact of such transactions, where its purpose was to avoid paying corporate tax. From our observation in the UAE corporate tax law, we completely agree that it is in line with the international tax reforms that are recently implemented across the globe, sponsored by the Organization for Economic Cooperation and Development, OECD. Having said that, the CT law adopts BEPS project key recommendations. BEPS stands for base erosion and profit shifting. The primary objective of BEPS project is to safeguard tax administration's revenue from being shifted from their jurisdiction to a low or no tax jurisdictions. UAE corporate tax law has adopted PEP's Action 4 recommendation on the limitation of interest deductions, limiting it to 30% of EBITDA. This is also known in the international sphere as the country fixed ratio rule. Additionally, for an equal footage, we observed the exclusion of some low debt levels taxable persons from such limitation, where their net interest expense is below or not exceeding 12 million dirhams. That's it about BEPS and interest. So now let's go to our next interesting topic about doing business in the free zone. So next slide, please. So free zone meant, in fact, to play an integral part of the UAE economy. Hence, we can observe that under corporate tax law Article 18, it emphasized the probability of driving qualifying income that will be subject to tax, but at this time at 0% rate, in accordance with Article 3, Clause 2A. Therefore, in order for businesses to be an eligible party for the qualifying free zone person, QFZP, which is an impressive benefit under his corporate tax regime of 0% corporate tax rate. There are 5 key conditions have to be met to be an eligible person. Those conditions can be found under Article 18, Clause 1. By the end of our webinar, you should have a comprehensive understanding of such key conditions. It's worth to note that there is a limitation of up to 4 tax periods in case a person disqualified from being QFZP and wants to opt in back. So businesses should be very cautious about this. Let's simplify the concept. For the sake of simplicity, a free zone business that derive their income from one of the permitted and allowed activities, that business shall be eligible to benefit a reduction from 9% to 0% on that said income. Otherwise, they will be subject to 9% corporate tax. Now let's have a closer look at the 5 key conditions in order to be a qualified free zone person. First, substance. Second, qualifying income. Third, not elected to be subject to corporate tax. Fourth, comply with arm's length and transfer pricing documentation. Fifth, any other conditions that may be prescribed by the minister, and we will discuss this in brief. Let's go to the next slide to discuss the 5 key conditions and criteria to be eligible for qualified free zone person. Number 1, substance. Substance refer to persons that undertake its core income generating activity in a free zone, and they have regard to the adequate level of activities. They have adequate number of assets, qualified employees, and they incur a relevant amount of operating expenditures. Number 2, it's qualifying income. Well, qualifying income is a big concept that we need to consider. The concept of qualifying income has been introduced under the Cabinet Decision 55 and further elaborated in Minister Decision 139 of 2023, which encloses the determination of qualifying income and qualifying and excluded activities. In fact, Cabinet Decision 55 and Minister Decision 139, it represents a turning point for the UAE corporate tax federal law, where it witnesses the first introduction of qualifying and excluded activities and its correlation with substance and transfer pricing. Furthermore, for the sake of simplicity, that type of qualifying income, it would qualify for 0% corporate tax. We shall share a couple examples up in our next slide. So on the other hand, in case the businesses were undertaking any of the excluded activities, the 0% corporate tax rate is not an option. This means that they will accrue for 9% corporate tax. Number 3 is the not elected for being subject to corporate tax. Actually, the corporate tax law granted the ability for even qualified free zone persons to elect to be subject to corporate tax at 9%. We experienced this type of tax planning arrangements with some of our clients if there is a better tax planning strategy for example, tax group. Number 5 is complying with arm's length. Of course, we shall cover this aspect under the transfer pricing section, but arm's length principle and transfer pricing documentation is a key condition for qualified free zone person in order to benefit from the 0% corporate tax regime. Number 5 was mentioned in the law as other conditions that may be prescribed by the minister. In fact, there have been publications by the minister. It's emphasizing on 2 key conditions. First, the de minimis requirements. De minimis requirements meant to be like a threshold. As long as it's not exceeded, the qualified free zone person can still be eligible. If it's exceeded, then they will lose their benefit. The second key option is the requirement to have an audited financial statement, which reflects on my colleague part when he sheds the light on the importance of having financial statement. So de minimis is playing the role as being a safe corridor or a safe harbor rule for qualifying free zone person in case they derive non-qualifying income. At that time, it's either 5% of their turnover or 5 million dirhams, whichever is lower, as long as they are not exceeding the condition, they will be still eligible to be qualified free zone person. Yet we are in September 2023, but the community has observed the public consultation document that was issued on July 19th, and it was due by August 2nd, where the Minister of Finance actually, they showed their openness to receive comments, feedback, and notes from tax experts in the market, where we commented actually in relation to our clients' businesses for the list of qualifying and excluded activities under the free zone regime. We still expect that further clarifications and guides will be out by the Minister of Finance to navigate a clear path for some of the mentioned activities that maybe still represent a practical issue even for us. If you go now to the next slide, where we can initially think about in order to qualify as QFZP character, the free zone person has to be dealing with 3 types of businesses. First, dealing with other free zone persons, whereas such other free zone person represent a beneficial recipient or beneficial owner. Second, dealing with any non-other person only in respect, any non-free zone person only in respect of qualifying activities. Or third, deriving other income that satisfy the de minimis requirement we just explained. In fact, the term beneficial recipient is being derived from the international definition of unconstrained ownership or unconstrained entitlement to the tangible or intangible property. The qualifying activities, as you can see on the screen, it can be listing up to 13 different types of business activities that qualify to be subject to 0% corporate tax regime. On the screen, we listed and we combined a list of activities which majority of our clients undertake some of them. Those qualifying activities are manufacturing of goods or materials, processing of goods or materials, distribution within designated zones, holding company activity, operation, ownership, and management of ships, reinsurance services, treasury, financing, and headquarters services to related parties, financing and leasing of aircraft, and finally, logistics services. There is a misconception we need to address. The misconception is about whether those activities shall qualify for immediate exemption from corporate tax. In fact, alignment on the conditions and criteria of each activity has to be further technically assessed by a tax expert. This type of assessment is one of our key services we provide to our clients to test their viability to benefit from the free zone regime. In the upcoming slide, we shall have an example for some of the mentioned qualifying activities. We, of course, have observed a number of unique attributions for the qualifying activities, such as the introduction of entity characterization, for the manufacturing and distribution business aspects, which actually aligns with transfer pricing definitions and terminologies, especially in or for intra-group transactions. Now, on the other hand, the Ministry of Finance has listed also the excluded list under the same aforementioned minister decision. We shall cover some areas of those excluded activities in our upcoming webinar, inshallah. In next slide, we shall have a look over some examples of the qualifying activities. On this slide, actually, we shall illustrate to you some examples of the qualifying activities. We observed that some major related parties activities shall be earning qualifying income. In our first example, we will discuss treasury services to related parties. It is considered one of the qualifying activities. Actually, to delve into what is treasury services is, it includes financing and treasury services, including the provision of cash and liquidity management, financing, debt management, financial risk management, and its related advisory services to a related party. In our second example, we interpret the reinsurance services, which again considered as a one of the qualifying activities. The reinsurance meant to include the reinsurance business that assume all or part of a risk undertaken by another insurer or reinsurer under a contract. From the screen, as you can see, it's not dealt with the end consumer, because if it's dealt with end customer, this can be derived as non-qualifying income. Hence, it will not be falling under the qualified free zone person and be subject to 0% as a qualifying activity. So that's it about doing business in the free zone. Now let's have our next section, which is transfer pricing overview. So going to transfer pricing. Transfer pricing in its simple meaning is the fair price between affiliate and related party in comparison with unrelated parties' prices in common sense. It is called arm's length principle that is aiming at equal pricing when conducting business with related parties or connected persons. Transfer pricing documentation or the adoption itself is not new in the market, since UAE has adopted the country-by-country reporting rules or CBCR back in 2020, when issuing decision number 44, targeting large multinational enterprises where their consolidated turnover exceeds 750 million euro or around 3.1 billion dirhams. The CBCR meant to be reported by ultimate parent entity jurisdiction. Now back to the UECT law. Let's define what is a related party is. First, for natural persons, the related party is the dealings between natural persons up to the fourth degree of blood. Second, for juridical persons, for direct or indirect control or ownership of 50% or more of another juridical persons. Actually, we can observe that the definition is in line with the most common known definition of related party in the international markets. Control was introduced to reflect the influence factor, such as voting rights, composition of certain board of directors of another person, or receiving 50% plus of the profits. Second, let's look at the definition of what is a connected person. In accordance with Article 36 of the federal law, defining payments made to connected persons, it have to be arm's length in order to be deductible expense, which means and opens the way again for a possible or probable adjustment when dealings are non-arm's length. Connected persons can be owners of the business, directors, or officers, a related party, or other conditions as in those such as partners in an unincorporated partnership or any of their related parties. Under the corporate tax regime, as we speak, there has been no transfer pricing local guidelines published by the Ministry of Finance yet. However, the UAE corporate tax law indicated that the core application of transfer pricing rules are in line with the OECD guidelines. Till further regulation updates, we can shed the light on the international adoption of the OECD version of the transfer pricing guidelines TPG across the region for the application mechanism. If we pause for a second to quality think over the adoption of the three-tier documentation under both the federal tax corporate tax law and Cabinet Decision 44 of financial year 2020, again, we can sense a further adoption of PEPS project recommendation, but this time under PEPS project 13, transfer pricing documentation and the country-by-country report. In essence, transfer pricing as introduced in the bylaws of the federal law indicated the requirement to have the three-tier documentation is first, a local file, second, a master file, third, transfer pricing disclosure form for the in-scope entities, which meets the conditions outlined under the aforementioned articles. So as long as or so long the criteria is met and the key conditions are 200 million turnover or plus 200 million turnover, and the second criteria is the entity is part of a multinational enterprise group that their consolidated turnover is 3.1 billion dirham or 750 million euro in brief. Actually, that's it about transfer pricing for today. And now we shall move to our Q&A. So over to you, Rahma.
Thank you, Abdurrahman. And now we are going to begin answering the questions submitted during today's presentation. As a reminder, you can still submit questions through the Q&A link. For the sake of time, in case we couldn't answer any of your questions, you can email us and we will try to do our best. Please make sure to leave your email address and name accordingly. So, Abdurrahman, our first question is from actually Mr. Abdul Karim. I have a few questions. He was saying the first question is it mandatory to register in the corporate tax? We are already registered in VAT.
That's a very common question, and actually we receive such questions. In fact, the corporate tax registration process is different from the VAT registration process. Each company and each person that has a trade license, they have to have a separate process for the CT registration and obtain a different TRN number.
Great. And the second question is, what is the last date of registration?
As we speak, there are no deadline for registration process or penalty scheme, we can say. But yet we can say that the soonest is the best. As we know already, the fiscal regime has already started since June 1st, or for fiscal years starting on June 1st and onwards. So I assume that if the business is already active, so that you have to proceed with the registration process as soon as possible.
Great. Third one is, what is the accounting / fiscal year?
A fiscal year is usually a span of 12 months that the businesses have for their financial reporting purposes. It's either, usually the standard is Jan through December. Sometimes you might have a different fiscal year, but by anyhow, you should have your fiscal year end for the corporate tax purposes, because while you are trying to register for corporate tax, the tax period, you must select one of the available options, whereas it must be in comply and it must be harmonized with your financial reporting period.
How individual will be registered? That's the fourth question.
When we say individuals, I believe that the mention here is for natural persons. In fact, natural persons can be subject to corporate tax under the federal law. if they are commencing business or business activity as per the regulations. It is currently, we can say to the extent it is not 100% clear, but the rules mention that if the person is driving more than 1 million turnover from a business or a business activity, they will be subject and pay the corporate tax.
Last question from Mr. Abdul Karim. What is transfer pricing?
Well, that's a big question that we just covered the very first introduction about transfer pricing. You can see from the demo that we just made, it's the related party transactions between a multinational enterprise group or a group of companies dealing with each other. It can be also considered an intra-group transaction happening, and we usually see that perhaps a company that is dealing with goods or services or royalties and so on of such type of transactions, they are dealing with each other. The transfer pricing meant to say how much exactly you are transferring the product or the service that you are dealing with between those related parties.
Okay, another question from Mr. Kamran Amir. So will deferred tax needs to be calculated and disclosed in year ending December 2023 financials?
In fact, the question maybe a little bit need more clarity, but usually the corporate tax is being calculated by maximum 9 months after the fiscal year end, and you have to go through the tax process or the tax adjustment process in order to attain or reach out to your adjusted taxable income, where you have to make the necessary adjustments as per the corporate tax law for or to your financial statements.
We have another question from Mr. Muhammad Fathallah. What is the threshold of local file?
The threshold of transfer pricing documentation, they mentioned that 200 plus million dirhams of one company that can generate 200 million plus, or it is part of a multinational enterprise group that has a consolidated turnover 3.1 billion dirhams. In fact, the transfer pricing documentation in the UAE has a different scheme that where we can see that even those transactions between free zone and mainland will be subject to corporate tax, will be subject to transfer pricing under the Article 35 and Article 55 of the corporate tax law. So this is first time to witness such. Transfer pricing has been around in the region for so long. The key point is usually it is maybe viewed as a way to abuse paying corporate tax or paying and shifting profits from one jurisdiction to another. And here in the UAE, we can witness that they are treating the free zone person dealing with mainland has to be arm's length as well.
Okay, we have another question from Mr. Huzaifa Zakir. What if one of company has 2 trade licenses? So how to do registration?
Trade license registrations, I assume you are not referring to any of the UAE branches. I assume you are referring to a separate entity. Each separate entity, even if it has a tax group for VAT purposes, or in simple words, we say VAT group, each separate entity has to register for corporate tax by itself separately and obtain a separate TRN number.
Okay, another question from Mr. Omar. Is there any benefit available for VAT paid against corporate tax liability? Sorry.
That's a question that, let's say, VAT has not actually direct relationship with corporate tax. However, if you are paying or you are incurring a non-recoverable VAT, that can be a deductible expense. But if your VAT is a refundable or recoverable amount, you cannot claim it against your deductible expenditures.
Okay, we have another one is Can you please, from Mr. Delorom, can you please give more info about taxable person less than 3 million in CT? What is mean submit books, accounts, cash basis of accounting?
Well, the 3 million turnover is meant to shed the light on the business relief or the small business relief SPR. It's meant to last for 3 years, starting the first year in 2023 and onwards till 2026. The key reason of having the 3 million, less than 3 million threshold is to grant the ability for small businesses to benefit from a simplified tax procedures, from a corporate tax process, from financial point of view, and etc. They might be eligible to have the ability to use a cash basis accounting or accrual basis accounting or simplified IFRS for SMEs. It's a big one. It's a big topic, interesting topic for small, medium enterprises. But this eligibility cannot be combined with qualified free zone person, and it cannot be combined with an entity that is part of a multinational enterprise group.
We have another question from Mr. Harris. If a company makes software and sells to the companies in UAE, then will this income become qualifying income?
This is a very good question. Actually, this type of question has to be assessed on a case-by-case basis. We usually have to review the amount of nature of activity, the contractual terms and conditions, and to see and navigate through the qualifying activities and make a test. The test is usually made to test the viability of being accepted as qualifying activities. We have shed the light on some of the qualifying activities and the excluded activities. Yet there is a misconception about software that it might be considered the exploitation of intangible property, and it might be falling under excluded activities. We yet are waiting for more and further clarification from the Minister of Finance about the software development parts. And again, it's case-by-case basis.
We have a question also from Mr. Manzurul. He's our client, Emerging World. So he said that our turnover is approximately 900 million dirhams. 400 dirhams turnover from sales to UAE mainland, and 400 million is export from UAE and other countries, third part. My question is, 9% tax will be applicable on the profit we made from 500 million export / third port export?
Well, in fact, this is a big amount of case. That case has not, it's not a yes or no question. There has to be tests to be done. Like I said, it's a technically assessment that definitely we have to abide by and meet the conditions and criteria and look through for the 5 key conditions to be a qualified free zone person and the eligibility criteria for 0% corporate tax.
Great. We have another question from Miss Abir. Oh, sorry, Mr. Imran first. If a company is registered now in the corporate tax and after some time he want to close company, we have to deregister in corporate tax also?
Once the registration process has started for corporate tax, and later on, if your business is becoming inactive or dormant, you might be applying for the deregistration process for corporate tax purposes.
We have one more question too from Ms. Habir. Are there going to be any city benefits for inland companies similar to FZE companies?
That's a good question, actually. The benefits that for the mainland is typically different. It has to be assessed. Either perhaps you might be subject to the 375,000 profits relief or 0% corporate tax. Your business might be eligible for the SPR or small business relief. So it's a case by case where we need to assess the opportunities that you might have for your business.
We have a couple of questions. We have 8 more questions still open. Do we still have time to answer on that, Abdurrahman, or what do you think?
I think we can take it over, and we can get in touch with our audience for their upcoming questions, and they can feel free to shout us on our email to have their questions answered. Of course, we have more webinars to come up. We will delve into more details about transfer pricing and about the financial statement parts. So of course, those questions either will be addressed during our upcoming webinars, or we can have it separately.
Okay, great. Thank you, Abdurrahman, and thank you everyone for attending today's webinar. If you have any other questions and or feedback, please reach us out on info@alliance-.com. Please follow us with our upcoming webinar. And once you leave today's webinar, you will receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of Alliance Prime Accounting and Tax Consultancy and our presenters, thank you so much for joining us today, and have a great rest of your day.